Hello, welcome to this week's How's the Market, Pensacola. Well, we had the Seafood Festival this past weekend, and I got a chance to do actually some reading. I hadn't had a chance to sit down and actually do some leisure reading in a while, and I was reading a story about Winston Churchill when he was a kid, and it kind of made me think of this show. Basically, what happened was Winston was on holiday, what they call over in Britain. We just call it vacation around here. He was out on vacation as a kid with his younger brothers, and they were on some estate that his dad had took them to, and it was 50, 60, 70 acres, full of pine trees, but they actually had this little cliff and a small bridge that went over the cliff because there was another side of the cliff, so it was kind of like a little gully. Anyways, Winston was playing hide and seek with his brothers, and he was winning. He was evading both of them, and he said after about 20 minutes that he wanted to cross the bridge, and when he got about halfway on the bridge, he realized that he had been outflanked on both sides. So there was a brother on each side, right, waiting on him. And so he thought, there's a bunch of pine trees below me, nice fluffy needles. So if I jump, and it was probably 20, 25 foot in the air, if I jump, maybe further, I don't remember, that he could stick his arms out and break the fall because he would hit the branches and each branch would slow him down and actually break the fall. Churchill himself actually went on to say, well, the assumptions were correct. The data was absolutely wrong. That's one of the reasons I do this show right now, because you can make assumptions all you want to about what type of market it is, but the data has to be right to back it. At the end of the show, I'll actually tell you what happened to Churchill. Let's talk about real estate. Let's go. All right, so if you've never seen the show, I always start off with this slide right here. It says if we have between 6 and 7 months worth of inventory, we have a neutral market. Anything greater than 7 months is considered a buyer's market. Anything less than 6 months is considered a seller's market. What the slide does not say, anything greater than 9 months is considered a hyper buyer's market. Anything less than 3 months is considered a hyper seller's market. Let's take a look at our two counties and see where we are for the week. In Escambia County, everything under $550,000 is considered a hyper seller's market. For those of you who have not seen the show yet, over here on the left is your price points. On the right, the reason we color code them is so we can talk about what type of markets they are. So everything under $550,000 is a hyper seller's market, and everything else is a seller's market. So there is no neutral, there is no buyers, there is no hyper buyers in Escambia County. Let's shoot over to Santa Rosa County. Santa Rosa County, I've been complaining about for a year and a half now, because I was complaining about it January and February 2019, not having enough inventory. We still do not. Everything under $700,000 is a hyper seller's market, and the luxury of $700,000 plus is showing orange because that's considered a seller's market based on our definition. So our definition is everything under 6 months is a seller's, everything under 3 months is a hyper seller's, and since this is 3.1, right on the cusp of the hyper sellers, it is considered just a seller's. The data is showing you that if you're coming in at Santa Rosa County or Escambia County, 200 to 250, things are selling, right here this says list to sale ratio, between 99 and 100% of list price. So I've had some buyers come in lately wanting to nitpick stuff, saying, well, there's this one crack in this tile. Sellers don't have to fix that right now. They're still going to get what they need to. If the roof's gone, if we've got a blue tarp on the roof, okay, well then maybe we need to talk about assigning an insurance policy or something. But I've seen people trying to nitpick and get 20% off. Those assumptions are and especially if you got on the internet and you started researching and, these are first-time buyers. I hate to call them rookie mistakes because they're not. The assumptions are right if the data backed it up. And in 2012, we could have said that. 2013, we could have said that. So watch where you're getting your information from. That's the whole reason I do this show, is so that I can give you the data to match whatever assumptions or counteract whatever assumptions you are making. Okay? In Santa Rosa County, you're going to be offering pretty much what they're asking, unless they're ridiculous. I mean, I am going to pull comps, comparables, and see what's sold. And if everything's sold in the neighborhood, for $135,000, and these guys are on the market for $300,000 for the same type house, same year, everything else. I'm going to be asking why. But pay attention to the data. Now, as far as Churchill's story, I want to make it a quick show today, but as far as Churchill's story, he said he jumped, he felt the first couple of branches, and then 3 days later woke up in a hospital. So there's that. Yeah, the assumptions were correct. The data was not at all. Pay attention to this. This is interesting because now we're starting to talk about COVID, maybe having some vaccines. I've seen the Dow jump. It opened yesterday up 1,500 points. It wound up closing like up 800. I know that Pfizer announced the vaccine, and Eli Lilly this morning announced that they've got some good stuff from the trial. They got a go-ahead from the FDA. So it was kind of funny because one of the biggest stock arenas that was happening yesterday was travel stocks. And I got a call from both Royal Caribbean and Carnival wanting to know if I wanted to book my next cruise yesterday. That kind of cracked me up a little bit. Anyways, that will impact mortgages. Because if you've seen bond rates go up, bond rates have to go up to compete with higher equities. So they're trying to compete with the money. That means the rate of return has to go up to try and compete because people are making money in equities. So they're pulling out of bonds, going into equities. Well, as bond rates rise, mortgage rates have to rise because mortgage-backed securities are tied into the bond rate. So if I'm able to get 1% on a U.S. Treasury bond, then why in the world would I buy a mortgage-backed security which carries inherently more risk than a U.S. Treasury bond if I'm only getting 1%? No, I have to go 1 point something over that. That's why some of the financial stocks did so well yesterday, and I'm sure they're probably still doing well again today. Anyways, that's the show for the week. There's the data. Make your assumptions, but make sure the data matches it. If you're looking at doing anything, reach out. Let me know. Thanks for watching. Have a great week. My mission is to help people break through all the noise out there and don't need no permission. I want to help you get to actual truth. Don't you just want the truth?